Okay, so good afternoon, everyone. Welcome to today's webinar. We're going to be discussing today accounting implications of COVID. We obviously all know what there is around us, what's happening around us, and I'm joined today by a team. There's myself, David Leonardo. I'm a director in accounting advisory services within the assurance practice at PwC in Malta. I'm joined by Anita. Anita is a senior manager, also in assurance, with a focus also on audit, and she will be helping out with some comments on audit implications also arising out of the COVID-19 scenario that we find ourselves in. And also joining me is Daniel Galia, a manager in our tax and legal services. And Daniel will be also sharing some thoughts and comments on accounting implications from this pandemic that we find ourselves in. I'd like to kick off with a bit of an agenda, quite a high-level agenda in the sense that we've got 1 hour planned to go through materials and half an hour for question time. And during this time, may I add that none of us is going to be walking out of here with all the answers. But hopefully, the purpose of this seminar is that we can at least have a knowledge and an expectation of where, as accountants, we may need to be considering our nominal ledgers and what implications there may be arising out of the situation we find ourselves in. Naturally, the situation is evolving. It's evolving as we speak. It has been evolving for the past 3-4 months, and there's no doubt it's going to continue to evolve. So anything that we discuss is reflective of the situation as of today, but it's important that one watches the space carefully and sees what developments there continue to be around the sphere of the COVID-19. We're going to start off with a little bit of an introduction of where we are and how we got to this point. We'll then look at the changing environment and how this impacts us from an accounting point of view. And finally, we'll look at some other matters, both accounting as well as some auditing concepts and aspects in this regard. So just for everyone's sake and for the sake of clarity, we will be taking questions. However, we'll be answering questions at the end of the technical introduction that we're going to give. If you could please submit your questions through the chat function within the Hangout, as was already indicated earlier. We will then be taking questions, obviously subject to the amount of time that we have available. I'd like to kick off with a bit of a visual introduction to where we are today and how things have evolved and what you're going to see in this regard. If you can please just keep a note. I've got some on the bottom right of the screen. You have total number of people infected. This is numbers of confirmed infections on COVID-19. And there are the dates. I've put some pauses at the end of the months of December, January, February, and March. Don't read too much into the numbers. Different sources give different numbers. Some are slightly off, some a bit further off. It's not the exact number of people infected, which is important, as much as it is how the situation has evolved. So if we look at this presentation, we can see that up to the end of December, there were a few cases. They were constrained to China. By the end of China, it had announced that it identified some pneumonia, which wasn't really known. And by the end of January, the situation was that we were still at about under 10,000 infections. They were practically all within China itself. The situation continued to evolve at a faster yet slow rate in February, in the sense that if we look at today, where we're looking at 2.5 million infections, by the end of February, we were looking at less than 100,000, less than 90,000 infections, and about 96% of those were in China and South Korea. The backdrop currently is March. And for March, one can see how things evolved very quickly. It took no time at all to go from 80,000, 85,000 at the end of February to 850,000, give or take, by the end of March. And then in April, we know that the situation continued evolving at a very fast rate, particularly in the United States, as well as a number of European countries. At the bottom of this chart, you have the different regions, the Americas and Europe being the top two lines. And this is pretty much the situation that we find ourselves in. It took something like 67 days from the first reported case until we reached 100,000 cases, about another 11 days to reach the next 100,000, and since then it has evolved at a very fast rate, even reaching 100,000 per day. So what does all of this mean to an accountant? Well, we need to look at a number of areas. So what we're seeing around us, a lot of these things that we're seeing around us, they have some kind of an accounting implication. I mean, if one thinks about the accounting standards that we follow, there are lots of different areas. We're going to be looking at a number of those today. So maybe I can say impairment. Impairment of financial assets, impairment of non-financial assets, fair values. Just to mention a couple of examples, we'll be looking into more of these as we go along, but that kind of sets a bit the scene in terms of what we're talking about. So it's not business as usual. It's clearly a very different kind of usual that we're having to get used to. It's a new norm. How long it will last, we don't know, but we do need to keep our eyes open in respect of the accounting implications. So with that being said, I'll head straight over into discussions on different areas and aspects of what we are seeing around us. I've got here some headlines that have made the news in recent times. There's obviously been loads of headlines across the board, locally, internationally, and the one key message that I guess we could all agree on is that it is not what we're used to. It is all new. It is quite a big impact. We've seen factory closures, which means industry and sector, tourism sector has ground to a halt, and lots of other sectors and industries have been impacted by this situation, this pandemic that we find ourselves in. So what could all of this mean? And it is extremely wide-ranging. So this general uncertainty that we are talking about, it can lead to things like, I've already mentioned impairment and fair valuations, but it could also be something that's closer to home. So if one thinks about inventories, the value of inventories, which isn't dealt with by IFRS 13. It's got its own standard, and it requires us to measure inventory at the lower of cost and net realizable value. If we think about financial instruments, there are fair value considerations, so instruments which are measured at fair value, but we also know we have instruments measured at amortized cost. And those instruments measured at amortized cost under IFRS 9 are subject to impairment assessments and impairment provisioning and allowances. We've got situations where one might find themselves in a situation where there is an onerous contract, which is covered by IAS 37. So on the right-hand of this slide, I have supply chain issues. Naturally, for anyone in manufacturing, there is some kind of raw material or input into the process, and even if one is able to keep their factory and their processes open, it doesn't mean that the suppliers are in the same situation. So what happens if one has a supply contract, is committed to supply a number of manufactured items to its customers? It's got days by which it must supply, and the situation has arisen where the normal supply chain has been blocked as a result of factory closures in China, as a result of logistics problems getting raw materials to the factory. It could be a multitude of different reasons where and how one is encountering difficulty. But if that means that the entity is either going to not be in a position to supply the customers in accordance with the contracted arrangements, or it means that an entity has to supply those raw materials from alternative sources which are more expensive than the norm, then to the extent that there is a contract to supply that customer, and it is known that either there's going to be a breach of contract because the lack of raw materials means that you cannot have enough finished goods to honor your obligation with your customer, or on the other hand, you are in a situation where you can supply alternative sources, but it's going to be more expensive, and the extent of that increase in costs is such that you'll end up making a loss from the contract, then that is an onerous contract. Under IAS 37, the provision should be accounted for straight away, and one should not wait until the supply is actually delivered to the customer. One thing that I want to make clear from this stage is that a question that one would ask is, we know that COVID is having some kind of an impact on us, but when should we reflect the impact? I mean, I've just mentioned that under IAS 37, one should provide straight away if it is known that there is an onerous contract. To be clear, what we're talking about here is the accounting that needs to be done if there is an impact on an entity. And that might be in the financial statements whose year end has already passed, but the financial statements have not yet been issued. Or it could mean that we're talking about a post-balance sheet event, and it would be accounted for after the financial statements, which have not yet been authorized for issue, but the year end has already taken place. It could be both scenarios, and a lot will depend on the year end of an entity. So let's take a December year end. If someone has a 31st December year end, the financial statements have been prepared or are being finalized, but they haven't yet been issued. Would COVID-19 be expected to be an adjusting event? As we saw in the introduction I gave, the number of cases by the end of December was under 30 reported cases. Obviously, that figure is subject to what's been reported officially by the Chinese government and authorities. But it was very contained at that stage. It wasn't known that it is a coronavirus. It was known that there was some kind of pneumonia. It was very constrained to a specific region, the Hubei province in China, where Wuhan is the main city. So clearly, for someone who is in Malta and doesn't have trade with China, 31st December year ends, I think it is pretty clear that it would be a non-adjusting event. So for anyone who has a 31st December year end, then when we're talking about looking at inventory, looking at non-current assets, looking at financial assets, looking at onerous contracts, and looking at leases, government assistance, these are all areas that we have been seeing things around us on which the relevant accounting standards would be relevant. If an entity has a 31st December year end, then what we're talking about is that these are non-adjusting events, and they should be reflected in the financial statements for the year commencing on 1st January 2020. Now, depending on one's situation in terms of whether they prepare interim financial statements or not, the first reporting date for that entity with a 31st December year end could be 31st December 2020, in which, of course, COVID is an adjusting event, or it could be some interim financial statements. We also saw that in March, the number of cases was 850,000 plus. It was spreading like wildfire throughout all the Western world, the Americas and Europe. Asia also significantly impacted. So I think it is also fairly easy to conclude that with an entity having a 31st March 2020 year end, the COVID situation would be an adjusting event. It is very difficult for an entity not to have been impacted by COVID if it has a March year end. That being said, there is an element of judgment, and I'm not trying to take any judgment away from any practitioner. So obviously, everyone does need to look at their own situation But to the extent that one is impacted by COVID-19, then if there is a year end of March 19, I think it is quite difficult that one would have a March year end, is impacted, but by 31st March was not yet significantly impacted. That triggers the question, what if our year end is January or February of 2020? And that's where more judgment will need to be applied. If it is quite clear that at 31st December, the COVID situation is not adjusting, whereas at 31st March, it is adjusting, what that means is that somewhere in between, it shifts from non-adjusting to adjusting. Judgment will be required. As we saw, by the end of January, there were less than 10,000 cases. About 99% of those were in China. The lockdowns in China had already started. So one question that I would find myself asking is, to what extent is my business impacted by China? So am I buying directly from China? Am I sourcing goods from China? Am I supplying China? And specifically, China is, of course, a huge nation. Is it the provinces that were impacted by the end of January? To the extent that the answer is no, without actually saying it, I think I have a pretty good indicator of whether that would be an adjusting event or a non-adjusting event if my year end is January. A lot will depend to what extent I am impacted by those, what happened and evolved within China, where 99% of cases were contained by the end of January. Again, by the end of February, the number of cases had risen to about 85 to 90,000. About 96% of those cases were in China and South Korea. The outbreak in Italy had started. So again, one would be asking themselves, to what extent is the level of business with China, South Korea, Italy, where the outbreaks had already started and the situation was evolving. That being said, we know as accountants, there are situations where we have to make judgment, and this is clearly one of them. One thing to keep in mind is that whereas the judgment might be relatively straightforward in some cases, like for example, if you have a 31st December or a 31st March financial year end, it could be more complicated if you have a January or February year end. Could be, not necessarily, that's a judgment that each practitioner needs to make. However, one should keep in mind that where the judgment is at a higher level, then there are disclosure requirements that one needs to think about under IAS 1. So IAS 1 does require that significant judgments that have been made by an entity in preparing a set of financial information needs to be assessed. And if there are judgments that could materially change what is being prepared in the primary statements, the statement of financial position, the income and expense, etc. If that's the case, that the judgment has highly impacted those statements and the amounts therein, then disclosures are required of what the judgment is, what has been considered by management, by the preparers, in determining whether it is or is not an adjusting event for the year end in question. Naturally, the bigger the judgment, the more one needs to explain carefully and clearly what judgment has gone into the assessment. From the point of view of financial accounting, the impacts are, of course, quite a lot more than this little bit of an introduction that I have given. So through this, what I wanted to extract is it is quite far-ranging and far-reaching. So the number of standards, if one thinks about it, that may be impacted or rather that need to be applied is quite large. And now we'll delve into a bit of these in a bit more detail. So at this stage, I'm going to hand over to Daniel Gallia, who will talk us through a couple of areas himself. Daniel, all yours.
Thanks, David. So I'll be taking us through a couple of areas, particularly the reduction in risk-free rates and putting major projects on hold. So to start with the reduction in risk-free rates, as a broad recap, essentially a risk-free rate is a rate of return on an investment with theoretically zero risk. It's typically used as a benchmark to measure other investments, which would include, of course, an element of risk. However, these rates, of course, are used as a starting point for many discounting requirements and procedures, such as asset impairment testing or ECL preparation or fair value measurements, and the list goes on. As I'm sure you're all familiar with, typically government bond yields would be considered with risk-free rate and are most commonly used rather as benchmarks across different countries. Risk-free rates, of course, will be expected to decline due to COVID-19, given it is an abnormal situation, which has brought about, of course, a lot of risk and uncertainty over what we would typically consider to be a risk-free benchmark. Having said this, interest rates have been shifting during this time, though in Malta, one must still monitor these, given that so far there have been no major announcements in terms of, for example, the Malta government stock yields. Therefore, so far, fluctuations have been relatively flat between January up until mid-March. However, what's quite interesting to note is that towards, I'd say, late March, there was a spike noted in these rates, which was essentially when the number of cases in Malta exploded and panic sort of ensued. What's interesting to note is the data following that, namely towards the end of March and early April, the curve, so to speak, of these price fluctuations actually dipped again and flattened. And that's primarily attributable to, for example, the EU stimulus and injections that have happened around that time. So based on current data to date, we actually note that these rates have now flattened again and so far remain stable. These fluctuations, of course, would be expected to be directly impacted by events such as further government interventions in the form of stimulus packages, for example, as we have seen recently. Of course, as David mentioned, this gives rise to a few considerations in terms of impairment assessments. So in terms of non-financial assets, for example, most, if not all entities have suffered an immediate decline in their business activity, and most are expected to be affected. So this could potentially lead to a number of indications of impairment of some assets, both financial and non-financial. So management are going to have to assess the potential impairment of, for example, non-financial assets, and would need to consider, amongst other things, the impact of reduced cash inflows over the near term, or increases in operating costs and other costs. Assumptions and cash flow forecasts used to test for impairment should be updated to reflect the potential impact of COVID-19. Very importantly, including forward-looking information, which in itself, understandably, could be a challenge. Calculations used in earlier impairment testing exercises, perhaps, would need to be readdressed to determine, for example, an asset's recoverable amount. Possibly, they need to be revisited and revised to reflect current economic conditions, of course, and even those at balance sheet date to address the increased risk and uncertainty. Something that would come to mind here is, for example, it could be challenging in terms of a recoverable amount of an asset, for the sake of the argument, determined to be its value in use. Now, here, the discount rates, of course, would need to be adjusted to factor in the risk brought about by COVID-19, which is not, of course, a straightforward process to do. So an option management could also consider here is whether an expected cash flow approach could be taken, in the sense multiple scenarios will be set out by management, which are probability weighted, essentially, based on expected outcomes in terms of cash flows. This may be a better way to determine recoverable amounts of assets, rather than, of course, sticking to a single predicted outcome, especially in these trying times. The scenarios here may, for example, of course, factor in measures taken by countries to control the pandemic, which will directly affect business, assistance packages, as mentioned earlier. And as a result, it's, management are going to have a range of outcomes to consider across multiple scenarios. The approach of an expected cash flow is more likely more appropriate and easier to carry out for the time being, given the complications to come up with, of course, a sufficient discount rate to factor in the COVID-19 risk exposure for reasons previously mentioned. Very important that the factors used to determine these discount rates in calculating recoverable amounts should be revised to reflect the impact of the virus, including, of course, these risk-free rates, which we are discussing, country risk, which is going to be different, of course, all over, and individual asseties. These risks may not necessarily be moving in the same direction, since of course, entity-specific risk premiums on certain assets could be increasing, whilst at the same time the risk-free rate is decreasing. So it is always going to be very entity-specific. Ultimately, whichever approach management chooses to reflect the expectations about possible variations in expected future cash flows, the outcome needs to reflect the expected present value of these future cash flows, of course. So when fair value is used to determine the recoverable amount, the assumptions made should naturally reflect the market participant assumptions here. Just a quick note as well on financial instruments here. Of course, we've all noted, and naturally, that credit risk and exposure to, for example, receivables will be one of the factors most common to all businesses, I would imagine. So management here should consider the impact of the pandemic on both the measurement basis of expected credit losses, for example, that is whether it is measured at 12 months or a lifetime ECL. It may be the circumstances more relevant to adopt a lifetime ECL approach if there is a large increase in credit risk. However, having said that, this of course excludes assets that are subject to the simplified approach, which are always measured effectively using the lifetime ECL. And also the estimate of the ECL itself, which will include the risk of default, the exposure of default, and of course the loss given default. IFRS 9 does require that forward-looking information, including macroeconomic information, is considered both when assessing increases in credit risk and when measuring the expected credit losses. So it's therefore very important that additional potential scenarios in relation to the COVID-19 impact does form part of an entity's assessment, also of its main expected credit loss model. The fair value of assets or liabilities, of course, should be determined, as David mentioned earlier, with the applicable IFRS standards. The volatility of prices on various markets has increased as a result of the spread of COVID-19, which may either directly affect fair value measurements, such as in the case of active markets, brokerages, or indirectly, for example, if a valuation technique is based on inputs derived from a volatile market. Counterparty credit risk and the credit spread used to determine fair value might also increase. However, the impact of actions taken by governments to stimulate the economy might reduce the risk-free interest rates, as we've discussed earlier. Just to jump into as well the section for putting major projects on hold here, I think there are two key things to take away from this section. And I think the first and most significant one is going to be regarding the capitalization of borrowing costs during period of suspension of activities and projects. So the pandemic might mean that property, plant and equipment is underutilized, is not utilized for a period, or that entire projects of a capital nature are suspended for a period of time. Now, IAS 16 does require that depreciation is continued to be charged in the income statements, of course, while assets are temporarily idle, such as in the case of owned assets used by an entity in the development of a certain project, which perhaps is suspended. And key to this as well is that IAS 23, in respect of borrowing costs, requires that the capitalization of interest is actually suspended when development of an asset is suspended. So I think the important point to take away from here is that essentially, whilst projects of a capital nature or whatever are at a standstill, then There's going to be increased volatility in the P&L, of course, given that borrowing costs cannot be capitalized for that period, whilst at the same time, potentially depreciation charges on assets which is utilizing such projects will remain in the P&L. A very important point I'd like to close off on this section is, of course, what is expensed in the P&L in terms of borrowing costs for the period of suspension can at no point be capitalized in the future. So it's very important to bear in mind that once a project does resume, any borrowing costs that were previously expensed can by no means be capitalized. And that brings me to the end of these two sections. So I kindly ask if you've got any questions to include them in the comments, and we'll address them after the session.
Thank you, Daniel. It's interesting to note. I mean, you mentioned the temporary suspension of major projects, and it was something like 10 days ago when a major development that is taking place in Slima, the developers announced that for the duration of the pandemic, they are suspending the excavation works. I don't know the extent to which works are stopped. I don't know if it was just excavation works which were going on. But if that's what was going on, and that's been suspended, then this would exactly be what IAS 23 is talking about when one talks about suspension of projects for a period of time, with the result that capitalization of borrowing costs must be stopped for that period of time during which works are halted. Whatever is expense in the P&L, because it fails to qualify for the interest capitalization criteria, will subsequently have to stay in P&L. So when the project commences once again, the entity would not be able to capitalize any interest costs that were previously expensed. I'm going through some other headlines that we have had. These are local headlines that we encountered in the very recent past. And again, the topic that you can see, I presume you've gathered what the topic is, and that is forms of government assistance. There are different forms of government assistance that one can see in the current scenario. A number of packages and revised packages have been announced by the government. We're seeing also assistance at international level, not only locally, of course. It is worth keeping in mind that any assistance that takes the form of national, local, or international government assistance would fall under IAS 20, government grants. I mention this because to the extent that there may be assistance which one can tap into from an EU perspective, that would also, present or future, would also fall within scope of IAS 20. Now, IAS 20 is a standard which seeks to achieve matching. The objective of matching, when we're talking about matching, is that, in fact, the standard distinguishes between those projects, those forms of assistance, which are there to compensate an entity for its recurrent expenditure. In other words, expenditure which is not capitalized. But there could also be assistance which is there to facilitate, to subsidize certain capital expenditure. The way IAS 20 achieves this matching is that if the item which is being compensated, subsidized, whatever word you would like to use, by the government is an expense which is being recognized directly in the income statement. For example, subsidizing of wages. We have seen this locally announced. It is a measure that many governments internationally are taking. And the salaries and wages that are being covered by the government, those salaries and wages are a form of government assistance. So the employee remains an employee of the entity, and the government is subsidizing those salaries and wages. From a matching perspective, the matching is twofold. First of all, from a point of view of timing of recognition in the income statement. There are some conditions that need to be met in IAS 20 to recognize a government grant. And those include that it is virtually certain that you will satisfy whatever conditions exist for you to qualify for the assistance. Therefore, if the government were to impose certain conditions, one must ensure that they will be in a position to comply and satisfy those conditions. On the assumption that the conditions are met, there's matching from a measurement point of view. So if salaries of employees for the month of April are being subsidized by the government, the salary costs of employees are recognized during the month of April. The assistance should be recognized. Of course, when saying recognized, I'm referring to the income statement, should also be recognized in April. And matching is achieved in that way. The standard also allows for matching from the point of view of presentation. So from the point of view of measurement, I have just mentioned that the two would be recognized in the income statement at the same time to match each other. One has to be careful though. If the compensation is covering a period of 3 months, but is being received in one lump sum in any of those 3 given months, or even at an earlier or later date, the income statement matching should not follow the cash flow timing, but should follow the timing of the expense which is being subsidized. The second form of matching is in presentation. So IAS 20, under IAS 20, it would be acceptable both to offset the government assistance against the expense which is being subsidized. So to give an example, if a salary or a wage were to be of, and I'm going to use simple numbers, 1,800 of that were to be subsidized by the government, then one presentation format would be to offset the 1,000 cost with the 800 government grant, resulting in a 200 being presented as a net expense. That net effect is essentially the net cost to the entity and could very well be the amount of cash which is forked out directly by the entity. Another presentation format, which is also acceptable under IAS 20, is for the expense to be presented in full as an expense. In my example, that would be 1,000, and then the government grant would be shown as other income. One place where it cannot be shown is revenue, because it would fail to meet the definition of revenue. I also mentioned that there is government assistance, which takes the form of capital expenditure. Where there is government assistance that covers capital expenditure, again, there is matching in the income statement. The way that is done is that the government grant is initially recognized in the balance sheet, just like the capital expenditure is in balance sheet, and that grant is then released to P&L to match the depreciation or amortization on the asset. Once again, the same concepts for matching in P&L apply. Likewise, the same concepts that one can only recognize a grant when they qualify for the conditions that have been imposed, have been satisfied. Another thing is that even from a balance sheet perspective, to the extent that it is a capital grant on capital expenditure, a government grant on capital expenditure, then one can also offset the two in the statement of financial position. These are all allowed under IAS 20. The government assistance could also take the form of loans and borrowings. It could take the form of subsidized interest rates. All of these are types of government assistance, and one does need to keep a lookout for what forms of assistance an entity is qualifying for, is applying for, and is receiving from government, so that one can then ensure that the accounting correctly reflects the situation in that hand. Another area where there is kind of a similar type of assistance to borrowings is leases. With effect from 1st January 2019, we have had IFRS 16, and this concept of IFRS 16 is that all lease arrangements, with the exception of a few lease arrangements which qualify for an exemption, should be recognized as assets in the statement of financial position, and liabilities which are represented by the present value of lease payments. In other words, the lease liabilities. Those lease liabilities, in essence, are a form of borrowing, and some kind of assistance that one might get is concessions from the lessors. So if, for example, you are renting premises from a landlord and you're the tenant, and there is a concession being granted to you because the premises has to stay closed by government orders, and the landlord has decided to grant a concession, naturally one needs to keep in mind, is it a case that the landlord was obliged to grant a concession in the circumstances? In other words, was this something that was set out in the contract? Or is it something that the landlord has gratuitously given as a concession when it was not contractually obliged to do so? And that distinction, currently at least, has quite a big effect, in the sense that IFRS 16 has a mechanism that deals with the modification of existing contracts. In other words, where the contract did not cater for a concession and a concession was gratuitously given by the landlord, versus situations where the landlord is plainly and simply executing a contractual obligation that it had under the original contract. As of today, the date of this, the date that I'm speaking, the situation is that if the original contract made it an obligation on the landlord to grant such a concession, then that concession should be released to the income statement when it is received. So what one would do is get the lease payments that need to be made in the future, discount them to present value, which is the same process that one would have done originally when recognizing lease liabilities. Naturally, the fact that there are less payments to be made because the landlord would have granted a concession on one or more payments, means that the present value you would get from this calculation is less than the carrying amount you would have had. So in other words, if you had 10 payments of 100 each, and those had originally been discounted to present value, and the landlord has waived one or two of those payments, if you're getting less payments and discounting them to present value, naturally, the present value will be less than the previous amount, which included all payments. That difference would be recognized in the income statement if the concession was already contemplated in the contract, and the tenant would have had a contractual right to receive the concession. If, on the other hand, it is a gratuitous contribution, a gratuitous waiver of concession, then under IFRS 16, as we speak, then that adjustment should be recognized as a reduction in the liability, yes, in the same way as I've just described, but the double entry would not be recognized in the income statement. It would rather be recognized in the right of use asset, meaning that the benefit would be spread over the life of the lease through a reduced depreciation charge on the right of use asset. Now, this is the guidance that we have today on lease modifications. As we speak, the IASB is looking at this. It is looking at fast-tracking a change to IFRS 16. The objective of that change that they're looking at, fast-tracking, is that an entity would not need to assess whether concessions are a form of lease modification or not. In other words, one would not need to assess whether COVID-19 related concessions arise out of IFRS, out of the original contract or not, therefore bypassing the need to assess whether a concession would be a modification. And if that's the case, that this goes through, the objective that the IASB wants to get to is that all concessions would go straight to P&L without adjusting the right of use asset. One needs to watch this space because as we speak, there's still a long way to go. Yes, the IASB is fast-tracking this, but one needs to keep in mind we apply IFRS, is adopted by the EU in Malta, which means that first the IASB has to issue an exposure draft. Comments have to be received by the IASB. We then have to wait for the final standard, the amendment to the standard. We then need to wait for the EU to endorse it. And at that stage, one can then apply it. So depending on one's financial year end, we need to wait and play a game of wait and see. Moving on, there could be assistance from lenders, payment holidays. A number of local banks had indicated that they are going to be giving assistance. Since then, there's been a legal notice which obliges banks to comply, subject that borrowers qualify under meet certain conditions as stipulated in the legal notice. If so, they have to make an application, and banks have to comply provided that the conditions are satisfied. the type of assistance here is payment holidays. So to the extent that there are payment holidays, one needs to look at, first of all, whether there is a waiver or there is a holiday, a moratorium on payments. If it is a complete waiver, that would result in a credit to P&L immediately. If there is a waiver, a payment holiday, a deferral of payments of principal and or interest, in that case, one needs to get the revised payments that will need to be made, inclusive of interest, discount them to present value at the original effective interest rate, and compare the carrying amount that there is before this payment holiday, compare that amount to the figure that emerges from this calculation of getting the revised cash flows after this modification will have taken place and discounting them to present value. To the extent that there is a big difference in those cash flows, present value of cash flows, which, to be honest, I wouldn't quite expect there to be a big difference, because if there is, what it would mean is that it isn't simply a deferral of payments, but it would be a case of giving a concession, giving a waiver on payments. And I don't think that is what we are seeing locally. I think what we are seeing is deferrals. So if there is a deferral and the lender is going to be charging extra interest for the extra period of time granted to repay a loan, chances are that the present value from this calculation will not be too dissimilar from the carrying amount that there was. If that's the case, theoretically at least, any difference between the present value of remaining payments as revised by this concession, this payment holiday, and the carrying amount, any difference between those two amounts should be recognized in the income statement as a gain or loss. Another aspect that one needs to consider, this will be more relevant for entities whose year end is not 31st December, but is a later date. If someone has, say, a year end of March or April or June, and as at the financial year end, it is unable to satisfy its repayments or unable to meet its debt covenants on its existing borrowings, then one has to see what implications that might have. So if, for example, an entity has a borrowing, and under the terms of the borrowing, that loan will become all due on demand by the bank if the debt covenants are breached. For example, if the debt to equity ratio were to exceed a certain threshold, if profits were to drop to certain levels or revenues were to drop to certain levels, etc. If as at year end, financial year end, there is a breach such that the bank can, should it so decide, call in the entire amount, then that will have implications because if the bank can call the amount at will, it becomes a current liability as opposed to a non-current liability, even if the original term was such that the liability, the borrowing, has a long-term repayment. Any rectifications that take place after year-end are non-adjusting events. They would need to be disclosed, but still an entity has to reflect in its year-end financial statement of financial position, the position as it stood at that date. Moving on, in terms of another key message, one that anyone who's involved in the financial markets knows exactly what is happening in the markets. It's been quite a horror story for the past 2 months. There have been lots of days during which stocks prices have dropped significantly. We've seen record drops across many indices, both in Europe, Asia, and in the States. And that drop in market values, one does need to keep a lookout for. So to the extent that one has financial investments, if one has financial investments, they naturally need to be assessed. If there are equity investments under IFRS, they have to always be measured at fair value. As a reminder to what I said earlier, if one has a December year end, the drop in value that happened from the beginning of the outbreak in Europe, around mid-February, that would be a non-adjusting event for an entity with a December year end, even if the value of the investments or investment portfolio were to have hypothetically dropped by half since the turn of the year. It would still be a non-adjusting event. IAS 10 is very clear in this regard, but one would need to think about disclosures. From the point of view of financial instruments, which are bonds, the drop in fair value would need to be looked at if the entity is fair valuing those bonds. If the bonds are measured at amortized cost, then what one needs to be looking at is expected credit losses under IFRS 9, which is a topic which Daniel has already spoken about briefly with respect to whether those losses, the impairment provisions, should be looking at a 12-month expected credit loss or a lifetime expected credit loss. And that leads me on to the next point I have on this slide, which is financial difficulty at the level of counterparties. Where a counterparty experiences financial difficulty, naturally one expects expected credit losses to increase. Expected credit losses are the term given under IFRS 9 to providing for impairment on financial assets, debt instruments, basically. So we're talking here about trade receivables, other receivables, investments in bonds, and similar instruments. And IFRS 9 requires that one provides either at the 12-month expected credit loss or at the lifetime expected credit loss. The distinction between the two, with the exception of trade receivables, for which a simplification is available, the difference between the two is that the lifetime expected credit losses will result in greater provisions. What triggers a move from providing under the 12-month expected credit loss to the lifetime expected credit loss is, as set out in IFRS 9, the situation where the counterparty has demonstrated a significant increase in credit risk. So one does need to look at the current situation. First of all, let me start off with trade receivables. Trade receivables are where there is a simplification. One does not have to distinguish between lifetime and 12-month expected credit losses. However, one does need to reflect forward-looking information in the estimates being made. I repeat that we're talking about the estimates being made as of today, not the estimates being made as at December for a December year end. But if measuring ECL today, and one has an expectation that the COVID situation we find ourselves in is such that ECL's losses, in other words, from defaults by counterparties, debtors, will increase, then one should reflect that in the provision. So typically for trade receivables, one uses a provisions matrix, which is based on the aging of receivables, and one does need to give consideration to whether historical experience of losses is indicative of what might happen in the near future, or whether one should be increasing those losses, the loss provisions. So if, for example, one is exposed in their receivables to the tourism sector and hospitality, we know that the tourism and hospitality sector is obviously one sector which has taken a massive hit. And one question that is a pertinent one to ask is, should the expectation of losses in that sector, exposures to that sector, be reflective of historical losses, or should they be arbitrarily increased to reflect the best estimate of what's happening around us? I'm mentioning the tourism and hospitality sector only as an example, and not as meaning this is the only sector which is impacted by COVID-19. On the other hand, if one is not looking at trade receivables, then there is a need to consider whether a counterparty has demonstrated what I referred to earlier, a significant increase in credit risk. If it has experienced a significant increase in credit risk, that would mean moving from stage 1 of the 3-stage impairment buckets to stage 2. And stage 2 is where one moves from 12-month losses to lifetime losses. What that essentially means is that rather than limiting oneself to assessing the probability of a default taking place in the next 12 months, one would go beyond 12 months and look all the way until maturity of the instrument. Naturally, the distinction between 12-month and lifetime expected credit loss, given that we're looking at the horizon over which a loss might take place, it will only impact instruments which have a life of more than 1 year. If the instrument has a life of less than 1 year, the 12-month and the lifetime expected credit losses will get you to exactly the same position, because that life is of less than the hurdle of moving from stage 1, 12-month expected credit losses, to stage 2, lifetime expected credit losses. Which leads me to our final section, after which we'll move on to question time. So one question that all accountants need to be asking is whether the entity continues to remain a going concern. This is also dealt with by IAS 10, IAS 10 being the standard which deals with adjusting and non-adjusting events. However, when it comes to going concern is so fundamental to a set of financial statements. Think about this. IAS 1 requires financial statements to provide useful, relevant information to users of the financial statements. Those users include creditors, government authorities, lenders, investors, management, etc. If it is determined that an entity is not a going concern, meaning that it is not expected to be in business for at least a 12-month period from the end of the reporting period, the balance sheet date, that is such an important assumption that it's fundamentally ingrained into financial information. When you look at a set of financial statements, it is assumed, it is presumed that the entity will continue as a going concern. In other words, when you're seeing what assets there are, what operations there are, if you're trying to make decisions, do I invest? Do I lend? Do I give credit, 30 days credit, 60 days credit? Do I not sell on credit? If you're making decisions and using the financial statements to make decisions, it is of utmost importance to know whether the business is expected to be still in operation at least 12 months from the year end or not. For that reason, IAS 10 does not distinguish between adjusting and non-adjusting events for the purposes of assessing going concern. In other words, if an entity is going through significant financial difficulty today, April, and it has a December year end, and that difficulty is such that the entity is not a going concern, then the financial statements for December, which are yet to be issued, those financial statements cannot be prepared on a going concern basis. This is despite the fact that, as we discussed, COVID-19 and the pandemic are non-adjusting events for the purposes of IAS 10, if you have a December year end. So despite being non-adjusting events, one has to look at going concern. And if there are doubts on an entity's ability to continue as a going concern, there is the need to disclose that information. And the key to this is disclose. Disclose good information, disclose enough information. Disclose information that there are doubts. Disclose information that an assessment has been carried out and it has been determined that there is no doubt on the entity's ability to continue as a going concern. Disclose that the entity is not a going concern. The cases will be different. Every entity is the responsibility of management and the directors to prepare their own assessment and assess whether, in the current situation, they are reasonably expecting that the business will be still in operation by the next financial year end. So if we were talking about a December year end, the assessment being made now in April has to reflect that what will happen until, as a minimum, December 2020. And if it is still so wishy-washy, that it is so uncertain about whether an entity will be able to continue in business, it depends on how fast the economy recovers, then there may be doubts on going concern. And if that's the case, again, there can be repercussions. One does need to see if the entity is or is not a going concern. Again, this links to what I said earlier about significant judgments. It could very well be a significant judgment of whether an entity is or is not a going concern, and therefore disclosures would be needed. Disclosures showing what type of assessment has been carried out, what the outcome of that assessment has been. The disclosure would not require the inclusion of highly confidential internal data. So it wouldn't be obliging you to say, listen, my expected cash flows will be of so much, and my cash balance at the end of the year, we're expecting it to be in this region. It does not require one to go that far. But one should be disclosing what has been assessed and what the outcome of that assessment is. And if the assessment is that it is not a going concern, then the financial statements cannot be prepared on a going concern basis. If it is determined that it may be a going concern, it should be, but there are some doubts, there should be disclosure to that effect on where the doubts are and what could trigger that those doubts become realized. I've already spoken about adjusting and non-adjusting events. So I touched upon IS1 where it deals with significant judgments. It also deals in some instances with significant estimates. So if one is carrying out this assessment that we're talking about, Daniel spoke about discounted cash flows earlier and the discount rate that's being used, the scenarios that are being modeled, different scenarios. So hypothetically, a scenario in which within 3 months the economy starts to pick up and then it picks up relatively quickly. Another scenario in which it takes another 6 to 9 months of more of the same of what we're living today, and then it picks up at a fast pace. Takes 6 to 9 months and then takes a long time to pick up. These are all different scenarios. I don't have a crystal ball to tell you which of those will materialize. So if one is modeling, they probably need to model a number of scenarios when they're testing for impairment, when they're testing fair values, etc., unless those fair values are level 1 values for which there is a price in an actively traded market. In that case, we know what the price is. But if we're modeling, then one needs to be looking at multiple scenarios, both if it's modeling impairment of non-financial assets, impairment of financial assets, provisions under IAS 37. Those multiple scenarios and the weightings that we give them, you change the weighting, you change the scenario a bit, you change the assumptions going into each scenario, chances are there's going to be quite significant impact on the outcome, on the result. Whether a potential impairment would be of X in terms of euros or Y. If there are estimates which are being made and they are highly susceptible to change, then IS1 requires disclosure of that fact and requires disclosure of more information to help users understand. One of the things it suggests is disclosing a sensitivity analysis. So giving the base scenario that has been considered, but also showing what the effect would be and how the conclusion would change if reasonably possible alternatives were being used. So if I use the discount rate, which Daniel mentioned earlier, if one takes a discount rate, and I'm going to invent figures, of 5%, what happens if the 5% becomes 6 or 7, or it becomes 4? How would that have an effect on the result? These are things one needs to be aware of and keep in mind that IS1 does have disclosure requirements. The final point before I hand over to Anita is on interim reporting. For those who have to comply with IAS 34, IAS 34 being applicable to entities who prepare interim financial statements that are publicly available. IAS 34 requires that an entity needs not repeat disclosures that were already included in the year-end financial statements, but does include disclosures that were not adequately covered at year-end, such that the composite whole of the full year financial statements plus the additional information at the interim gives the user sufficient information that would be equivalent to what the user would have if that user were to prepare a full set of financial statements at the interim stage. So with that being our backdrop, we do know that that COVID-19 has brought a lot of change. We've been discussing, albeit at a high level, quite a bit of those changes in this afternoon. So it goes without saying that IAS 34 requires that quite a bit of disclosure will be made in the interim financial statements for 2020. I would expect that those interim financial statements will have a lot more disclosure than one is traditionally used to finding and preparing, for the simple reason that if on a normal in a normal scenario, the year-end financial statements, which were full financial statements, plus a little bit of interim disclosures, together give you an updated picture if you are the user. In the current situation we're in, the full year, where we said it's not an adjusting event if you have a December year-end, plus a little bit of disclosure will not be equivalent to a full set being prepared at the interim stage. And a user would be still left in quite a bit of darkness. So with that being said, one would expect that this year's interims are likely to have quite a bit more disclosure than the typical business as usual set of interim financial information. I'm now going to hand over to Anita. Anita is going to take us through some considerations from an auditing point of view this time round rather than accounting.
Hi, thank you, David. So obviously, from an audit point of view, once the company would have done its assessment, and they would have, the company would have come up with the disclosures. Now it is from an audit point of view, we would need to see what impact there might be on the audit report. Okay, so if the company did not have a material impact, okay, so for example, I don't know, a manufacturing company where the demand was not affected, the supply chain was not affected, liquidity was not affected as such, then the company would have, no implications on the audit report, okay? But obviously there are other instances where when the company is materially affected with this COVID situation, obviously the audit report can be affected in a number of ways. Going through the different scenarios that a company might be facing. So, for example, if the company was impacted, okay, so significantly impacted, but the company is still considered to be as a going concern. If it is a PI, okay, so if it's a listed company or an insurance company or a banking company or a bank, it might lead, if the matter is of a significant, it's leading to a significant audit judgment, then the auditor might feel the need to include a key audit matter, okay, to bring it to bring the matter to the attention of the users of the accounts. In the case of when it's not considered to be a key audit matter, or when we're not speaking about a PI, okay, when it is a non-PI, then if again the matter was of a particular significance, then it might be that we would need to include an emphasis of matter. We need to include an emphasis of matter to draw the attention of the user to that particular disclosure where where the company is disclosing the impact that COVID-19 had on the financial statements. In instances where the company's going concern now is impacted, okay, so there is doubt about the going concern, then there might be that would lead to an inclusion, a section being included in the auditor's report, particularly on material uncertainty on going concern, okay. In other extreme circumstances where there are material misstatements, or in the case of an adjusting event, or where there are disclosures are not adequate, or when we are not able to obtain sufficient appropriate audit evidence, then in those circumstances, the audit report would need to be modified, okay, qualification, disclaimer, adverse opinion, depending on the situation. Okay, so there are different scenarios that the auditor, from an audit point of view, obviously would need to consider. So that is the impact on the audit reports as such. Obviously, from an audit point of view, we are looking into other matters, okay? So just to give you one example, where COVID-19 could have an impact is, for example, the attendance of physical inventory observations, okay? So where we had, for example, instances where we had 31st March year-ends or where we're having 30th April year-ends and we are not able to attend a physical inventory observation, we would need to rethink how we can meet this requirement to attend the physical observation. Would it be a matter that we would need to attend the physical inventory account later on in the year, and then when everything goes back to normal, and then we'll do a rollback procedure? Or is it the case where the company still went ahead with the inventory count, and maybe we would need to rethink of how we can attend, maybe through virtual technology, how we can attend remotely this physical inventory observation. So these are some considerations from an audit point of view. Okay, so if you have any questions on this, please do let me know. David?
Thank you, Anita. This starts to bring us to a close, but we did state earlier, if there are any questions, please put them through in the chat and in the Hangouts, and we'll take it on from there. We did receive a question, but we've answered that as we were going along with respect to government assistance. If there are any further questions, please be our guests. In the meantime, like I mentioned earlier, naturally, a webcast like this, it's not possible to cover everything in full detail. I mean, these topics that we have touched upon, a number of them could be a few hours of discussion by themselves. But what we wanted to achieve from this is to equip everyone to be able to go back and give it a further thought, to assess where they may be impacted, assess how they might be impacted, and get those the juices in the brain cells flowing in terms of thinking about what kind of assessment needs to be made, helping you also in your discussions with the stakeholders that you have, whether those stakeholders are the shareholders, the board of directors, the investors, the audit process. We've just had a bit of an insight from Anita in terms of the implications that there will be in respect of the audit. And like I'm saying, what we wanted to achieve was that everyone feels a bit more confident about the situation and how it all has an impact on accounting. The judgment that one needs to make is still there. It's not going to be waved away just by listening into a webcast. But if through this we've achieved the objective of having people able to have something to go back and think about, and then see where they need to consult internally, where they want to reach out for guidance, etc. Obviously, everyone is in this forum here because we're accountants, we're qualified, or we've got a number of years of experience in accounting. So we each have a role to carry out, and hopefully it equips you to be able to carry that role out in as best a way as possible. It is an evolving situation, so keep in mind that practice will evolve even as we speak. I mentioned earlier the ISB is looking at making some changes to existing standards, so watch this space, and I'll give it another minute or two to see if any questions come in. If not, then I'd like to thank everyone for joining us this afternoon. So I'll give it a few minutes, and we'll take it from there. Okay, so we do have a question. The question that we have is how a lessor would treat an ex gratia concession or moratorium on leases. Before I focused on lessees, and with respect to lessors, to a certain extent, it is pretty much more of the same, in the sense that as of today, one needs to assess whether the original contract obliged the lessor to grant the moratorium, the payment holiday, or whether it is a concession that was not originally contemplated in the contract. If the lessor determines that it was already contemplated in the original contract that it had to give the concession, it would not be a modification. Whereas if it is a concession which was not required by contract, then that is a modification. So how does one account for these different aspects from a lessor's perspective? First of all, a lessor needs to assess whether a lease is a finance lease or an operating lease. Lessors still make this distinction. From the point of view of a lessor, which is leasing out property, that is generally expected to be an operating lease, just like it was under IAS 17. I'm going to make the assumption that where concessions will be given, the asset being leased out is immovable property. And therefore, I'm going to make the assumption that the lessor is looking at an immovable property operating lease. So if that is the case, then the requirement under IFRS 16, which is essentially the same as it would have been under IAS 17, is to get the lease payments that one is going to make and spread those equally over the lease term. That's the approach for an operating lease. Straight line the operating lease rental income. So to the extent that a modification is made, if the concession was always contemplated in the contract, which is generally not the case, but I can't speak in terms of is always the case, it's generally not. And in fact, that's the reason why the ISB is looking at amending the standard, because in most cases, these concessions are non-contractual. But let's say that it was, this modification was contemplated in the contract and the lessor is obliged by contract to give the concession. In that case, mirroring the lessee's approach, the adjustment would be recognized in the income statement directly. In other words, the lease rental would not be recognized to the extent that it has been waived. If, on the other hand, this is a lease modification, in other words, the contract did not or always contemplate the adjustment in the current scenario, then the modification is going to adjust the future cash flows under this lease. One gets the revised cash flows under the arrangement, straight lines the remaining cash flows, and the income in the income statement would be recognized on a straight line basis. What that would mean is that it will result in a lower monthly rental income for the remaining duration of the arrangement. Again, this is more or less mirroring what a lessee would do, subject that, in the case of the lessee, it would be spread over the life if it's a modification as a result of a reduced amortization charge, whereas in the case of the lessor, it would be spread over the remaining life of the contract as a reduced rental income. So in terms of the overall effect on P&L, more or less, there's a similar concept for lessors and lessees, albeit one is achieving it through an adjustment to the right of use asset, and the lessor, on the other hand, is achieving it through an adjustment to the monthly rental income. Okay, so as we start to run out of time, I'm seeing that no further questions have been submitted. So once again, thank you for joining us this afternoon. I wish you a good afternoon, all of you, and stay safe. Bye-bye.